Home prices are cooling at their fastest pace in history. Home buyers are cancelling contracts as mortgage rates hit 70%, leading to the worst home affordability crisis in 40 years. And unlike the mainstream media is trying to tell you, supply is increasing, inventory is rising, while at the same time, mortgage demand is absolutely collapsing. Borrowing capacity has been slashed in half, and this has initiated phase 2 of the housing market crash, which has already begun. I'm going to show you how big the crash is going to be and when it will bottom, so you can get ahead of the Wall Street hedge funds and finally buy that dream home you've always wanted to buy, or start investing in real estate for rock bottom prices. So I'm going to show you 7 indicators that prove that the housing market is crashing, with indicator number 7 being the most severe. So let's get straight into it. Wow, look at this everyone. Home prices have cooled in July at, look at this, its fastest rate in history, according to the S&P Case-Shiller Index. Hear that? This is the fastest housing market U-turn we have ever witnessed in history. So guess what? It is worse than 2008. And we're starting to break record after record, and not the good records. Reports on the ground from real estate agents that are saying the market is changing so rapidly. Literally, the market today is very, very different compared to just 3 weeks ago with how fast mortgage rates are rising. Another recent report from the National Association of Realtors showed home prices softening dramatically from June to July, and we're going to get new data for September and October, which will be much, much worse. Prices usually fall during that time due to the strong seasonality of the housing market, but the decline was 3 times the average decline historically. So yes, why prices do normally fall this time, this is 3 times the norm. And listen to this, the share of homes with price cuts reached about 20% in August, the same as in 2017, according to Realtor.com. And with many sellers only beginning to realize the housing market has shifted, as more and more sellers become realistic with their prices, we're going to see much more price declines. But that is only indicator number 1, everyone. That is only the first piece of the puzzle to tell us what is happening now. But what you want to know and what I want to know is, I want to know where this housing market is going. I want to know how much prices will fall and when is the bottom, so I can start hoarding cash right now for the perfect opportunity. Another very, very alarming trend, everyone. Home purchases are getting cancelled at their highest rate since 2020. Now, 2020 was unprecedented, so it's going to be very hard to top that, but we are coming very, very close, and I do think we will exceed that. Now, to think how extraordinary that is, the housing market cancellations are going to exceed what we had during a pandemic. And the reason they're pulling out is because, one, for example, when they've gone to buy the home, they thought, okay, maybe I could afford it with mortgage rates at 4 or 5%, but mortgage rates have risen so rapidly, now with mortgage rates at 7%, they can no longer afford to buy these homes, and they're going to have to downsize or look elsewhere. But not only this, some buyers are thinking, hey, wait a minute, I'm starting to see more inventory come on the market, I'm starting to get some more options now, so maybe I'll pull out of this deal and I'll buy this home. Or what many home buyers are thinking, 59% of US home buyers are saying they think the housing market is going to crash, so maybe they're pulling out of the deal now and saying, look, maybe I'll wait 6 to 12 months and I'll get this home for $100,000 or $200,000 cheaper, which would be a smart decision. So that's indicator number 2, everyone. But look at how bad things have gotten with indicator number 3. Look at this chart, everybody. This is home price to medium household income. So this is pretty much the price of homes, or how much years of income it'll take to buy a home. We can see here in 2005, it hit a record of 7 times people's wages to home values. Then you can see it dropped to record lows here in 2012, so it would have been a great time to buy then. But now look where we are. We are now higher than 2005 and 2008, with it now taking nearly 8 years of income to buy a home. And that's just the average, everyone. There's many cities where it is 10 to 15 times people's annual income to purchase a home, and these are unsustainable levels. And every time we've hit these levels, the housing market has crashed because people start to boycott the housing market. They're saying there's no way I'm going to be a debt slave for 30 years and pay these astronomical prices. And remember, the bigger the rise, the harder they fall, or the bigger the fall will be. Now, because we're starting from levels that are so overvalued, the crash is going to be worse. If we're starting at levels where the market was at fair value, maybe the crash wouldn't be so bad. But because house prices have gone so far, we're going to see a bigger drop, everyone. Okay, now it's time for indicator number 4. That's right, everybody. Inventory, inventory, inventory. What the mainstream media keeps on going on about, why the housing market won't crash, and what the real estate agents keep on going about, why the housing market won't crash. Now, look at this. This is the monthly supply of new homes in the United States. We can see here in 2009, it hit a peak of 12 months of supply for new homes on the market. Now, what we can see here is in September 2020, it hit a bottom of 3.4 months. So of course, house prices were going to rise. But we can see here, inventory for new homes is absolutely skyrocketing, and it hit a peak in July of 10 months, getting very, very close to the levels we saw in 2009, which led to the worst housing market crash in US history. And remember, history doesn't always repeat, but it often rhymes. Housing market be spitting all kinds of rhymes, just like 2009. Okay, now it's time for indicator number 5. Listen to this, everyone. Mortgage refinance drops to a 22-year low as interest rates surge even higher. And you know how many people commented and told me at the start of the year, interest rates won't go up. The Federal Reserve will never do it. At the most, they'll go to 1%. If interest rates go to 2 or 3%, the markets are going to crash. And yes, well, they were right. If interest rates go to 3 or 4%, the markets will crash, but they were wrong about interest rates not going up. Yes, they are going up. The Federal Reserve has no option right now. The Federal Reserve is in its biggest battle since 1980 against inflation, and this is a battle that they cannot lose. The stakes are too high. If they lose this battle to inflation, inflation is going to get out of control, and we're going to see inflation like we're seeing in Argentina and Turkey now, with levels nearly 100%. And the thing with lifting interest rates is you can always lower them, but once the inflation genie gets out of the bottle, there's no going back. So if Jerome Powell makes one slip up, one mistake, he's already so far behind the curve, we are all going to pay the price. And instead of having to lift interest rates to say 5%, he's going to have to do a Paul Volcker and lift interest rates up above inflation to above 10% to bring the inflation beast back down. But okay, you want proof that the housing market is falling. There's still many people that are in the fetal position, curling up in the corner, saying, no, there's no way that my house price can go down. There's no way that prices can drop. Well, people, they already are. We just got more data. Look at this. US home prices now posting the biggest monthly drop since 2009. Again, people, deja vu. We've seen this movie before. We know how it plays out. The best way to predict the future is to look at history. We can see it is playing out yet again. Median home prices fell, well, pretty much 1% in August from a month earlier, following a 1.05% drop in July, according to Black Knight. The two periods marked the largest monthly decline since 2009. And again, people, this is lagging data. Interest rates are already much higher than when these reports came out. So I think we're going to see bigger and bigger monthly declines. And remember, they start to compound, and it is like a snowball effect. You know, they have a little bit of decline here and there. Fear gets in the market. Sellers start to see prices falling. They start to panic. They start to drastically discount their homes to try to get ahead of the neighbor, Ned, down the street trying to sell his home. He's saying there's no way Ned is going to sell his house before me. I'm going to drastically cut this price and beat Ned. But I know what you're wanting to know, and I know what you're thinking. Okay, what cities are dropping the most? Well, could have you guessed it, everyone? The sharpest correction in August was in San Jose, California, down 13% from its 2022 peak, followed by San Francisco at almost 11% and Seattle down 9.9%. So it's looking like the California exodus is having a big effect on the housing market there, with San Jose recording the biggest falls, down 13% in just the past few months. But okay, it is time for indicator number 7, the indicator which is going to have the biggest impact on house prices. What is it? Let's get straight into it. Okay, look at this chart, everyone. This is a chart of the 30-year fixed rate mortgages. Now, remember, the housing market relies on debt. Most people are using mortgages to buy homes. Now, look at this at the start of the year. Mortgage rates were just 3.13%. But we can see, as the Federal Reserve has lost the inflation battle, as inflation has got worse, they've had to lift interest rates higher and higher to 4, 5, 6%. And now we have hit the critical mark, 7% mortgage rates. And with the Federal Reserve having the federal funds rate only at 3.25%, and many market analysts are pricing in, or the market's trying to price in, the Federal Reserve's going to have to go to 4.5 or 4.75%. And again, I've been calling for 5% the whole time. I think they will go to this level. Well, this is going to be huge amounts of borrowing capacity withdrawn from the housing market. Let's look at some shocking scenarios here, everyone. So, okay, this is a mortgage repayment calculator, and this is why interest rates have such a huge impact on house prices. We can see here, say for example, if you had a mortgage before of $400,000 and you had an interest rate of 3%. Well, your monthly repayments would be $1,696. But now that mortgage rates are 7%, that $400,000 mortgage is going to cost you nearly $1,000 more per month at $2,671. But you may say, Michael, I can't afford to pay an extra $1,000 a month on my mortgage. So you may only be able to afford that $1,700 monthly repayment. So how much are you going to be able to borrow now with interest rates at 7% compared to when they were 3%? And pretty much 90% of home buyers are going to be in the same situation. Look at this, everyone. You can now only borrow $250,000 with mortgage rates at 7% to keep that monthly repayment of $1,673. That's your borrowing capacity reduced by nearly 40%. And guess what? If the Federal Reserve lifts interest rates by another 1.5%, we're going to see mortgage rates above 8%. What that means is people's borrowing capacity is going to be cut in half by over 50%. And then it is just simple maths, simple economics, everyone. If mortgage rates go above 8%, we're going to see a 30 to 40% housing market crash. That's just according to the latest data. And if the Federal Reserve does lose the battle to inflation, they're going to have to lift interest rates even higher than that, and the crash could get even worse. Or the Federal Reserve could do the unthinkable. They could all of a sudden tell us, look, inflation's great. We're actually going to start cutting interest rates, and our new inflation target is 10%. But I could do a whole nother video on that scenario because that would cause the currency to collapse. So what this simply means is we have a perfect storm. We have a recipe for disaster. Hell is coming for the housing market, and there's going to be nothing to stop it. Now, this is not going to happen overnight. I don't want you to comment next month and say, the housing market hasn't crashed, Michael. You were wrong. Remember, in 2008, the housing market didn't bottom till around 2011. This could be a process that takes 2 to 3 years. It's not like the stock market where it can crash rapidly overnight. This is a slow moving train wreck, but a crash is inevitable. But hey, it's not all bad news. This is good news for first home buyers or young millennials or even boomers that haven't been able to afford a home. This could be the perfect opportunity for you to start saving cash over the next year or two to finally buy that dream home you've always wanted, or maybe you wanted to start investing in real estate because you know in the long term your currency is going to get devalued, and it is a good hedge against currency devaluation. So everyone, remember, every crisis creates huge opportunities. What I'm doing right now, I'm finding any ways I can to increase my income. I'm saving cash on the sidelines. And the great thing is you can actually get a little bit of interest on your cash now compared to 2020, even though it's not much. Interest rates are rising, so you will start getting a little bit of return on your savings. But what do you think? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.